And so my net, so for the purposes of this, my debt service is actually can be lower than it's shown here, which means that my numbers are actually going to be better than what they're going to appear here because my debt service is going to be too big. But you get the idea. My cash flow, therefore, is going to be the net operating income minus my debt service. Let's use my numbers here, even though just so that you know that I'm overestimating my debt service. Cash flow is 3,600. My cash and cash return now is 3,600 divided by. So cash flow is way less, right? It was 9,600 before. It's only 3,600 now. And you go, wow, that's kind of sucks. Well, it is much lower. However, my all-in expense is way lower, right? Because I'm not paying $100,000 in cash up front any longer. I'm only paying 20. So it's actually, now I'll give you the actual numbers. So ignore my example here. The actual cash flow should be 9,600 minus 4,800, which is 4,800. And so the cash and cash return should be 4,800 divided by 30,000. And it's actually 16%. So it's twice, almost twice what it is cash. Let me pause because, again, I apologize for making that little math error. Didn't catch it till just now. But does everybody understand what I just did there? Does that make sense? Did I lose you guys? Are you guys there?
Yes, that makes sense.
Okay. Are my overseas folks following me? That is a significant improvement in my cash on cash return. And a lot of folks that's why I don't want you to get too lost in the cash flow, because yes, the cash flow will be significantly less. In this case, it would be, if I did my math right, it would be half. However, your cash required to do this deal is way less than half. The seller is only accepting $20,000 at closing. That's a fifth of what they were accepting if they asked for all cash. So the fact that they're accepting so much less cash means that your risk is so much less as an investor. You're putting so much less into this deal. If you had $100,000 to do this deal, you could either do one of these deals all cash, or you could do 5 of these deals-ish with seller financing. So yes, the math here is actually understating the situation. It's actually 16% cash on cash return. And that would make most people, I think, sit up straight in their chairs and go tell me more about this. So, pardon my mistake. Everybody get this, though? You understand how at least the math works? We all good on that?
All good over here, Mitch. All good.
Okay, cool. Let's talk then about the main seller finance deal benefits, because I think a lot of folks think that the big difference between seller financing and bank financing is just that you can get a lower interest rate, or just that you're dealing with an individual versus a bank. And if it were just those things, that would be pretty good. But it's way more than just that. And these, in my opinion, are the real reasons why this is a killer strategy. First and foremost, these deals can close super fast because you're not involving a bank. Right now, closing with a bank, you're looking at 30 to 45 days by the time the bank orders the appraisal and asks you for a bunch of forms and makes you go through the proctological exam of looking at your tax returns and your credit report, et cetera, and drain you of a bunch of junk fees. By the time they do all that, all the smoke clears and the dust settles, you're looking at a month and a half easy to close a bank deal. I can close a seller finance deal with cooperation from the seller. I can close it as fast as title will clear because there's no bank involved. The seller agrees, I agree. If I've got the $20,000 in the example I gave before, we sit down and we close, we're done. So there is no massive delay for a seller finance transaction. They're super, super, super fast. Yes, you get way lower interest rates. We'll talk about why you can get much, much lower interest rates in a minute, but there's no central bank setting rates. There is no competition. There's no, all the other banks are doing it, so we're going to do it too. You don't have any of that. So I don't care what the Fed does when it comes to seller finance transaction. That's not going to influence the interest rate that I may or may not offer to a seller. I'm going to offer a seller whatever I think that they will accept. The last seller finance deal we did was out of Tulsa, Oklahoma, and that was less than a year ago, and we got 3 and change percent back when the prevailing rates for 30-year fixed for owner occupant was like 7 and change. So we get half, a little more than half of what owner occupants were going to pay. Investors were probably going to pay 8 to 9%. And at no point did that seller go, let me check my interest rate chart and see what I should be charging you. We negotiated that with her directly. She said, yes, I'll take it. And that was the end of it. And of course, lower interest rates means you can get into deals that all your competition is not going to be able to do it because they're going to banks and paying. Right now, prevailing rates for investors are like, even for US investors, like 8, 9%. You have more amortization options. And this one is probably the most important. Well, I won't say the most, but one of the most important ones, one of the more subtle ones. When you get a bank loan, you are almost always you're going to be looking at some kind of amortization, usually a 30-year amortization, sometimes longer, sometimes shorter, but generally speaking, the payment that you're going to make is a portion of it's going to be interest and a portion of it's going to be principal to pay down the balance of the loan. And that's because the bank wants to manage their risk and reduce that balance over time. Well, that's great for the bank. That's not so great for me as an investor, because as an investor, as a homeowner, buying a house that I'm going to live in, I see the virtue in that. I can see the value of building equity in my personal residence over time. But for an investment property, I don't want to accumulate a bunch of equity in the property. I want every dime that I've got going to either getting this deal done or doing more deals. Accumulating equity in the deal doesn't help me, because then I got to go try to pull it out with a home equity line or something like that. So I don't want to accumulate equity in a property that I've already bought. And so if I wanted to, and we typically do, we'll try to structure arrangements that let us only pay to a seller the amount that we can get away with paying, and we can then do a balloon payment down the road. So we could potentially minimize our out-of-pocket if we wanted to by adjusting the amortization to either have to be no amortization. We have done 0% loans with sellers. We have done all sorts of arrangements that favor us, because in most cases, the sellers don't care about interest. They care about the amount of money that they're going to get each month. And how much of it's interest versus principal is a distinction that most of them don't care about. So you can negotiate that in ways that benefit you as an investor. When you're closing with the seller, there are no junk fees. There's no application fee. There's no appraisal fee. There's no credit check fee. I've never had my credit checked by a seller when I'm doing a seller finance deal. They don't care about my credit. And I'll tell you why that's true in a minute, but all those fees that you're incurring when you deal with the bank, you're not having to deal with when you're dealing directly with the seller. At least we've not dealt with those. I'm not saying you couldn't offer it. You could, if you want to show them your credit report, I'm sure they'll take a look at it, but it is not our habit to even discuss credit. And we'll talk about why in a minute. When you sign a mortgage with the bank, if you look carefully at your paperwork, you'll notice that you are personally guaranteeing that loan, whether it's an investor loan or whether it's an owner-occupant situation. You have personal liability for that loan. If for some reason that loan goes south and they can't get all they need out of the house by foreclosing, they have the right, with your personal guarantee, to go after your personal assets. And as an investor, that's disastrous, because things happen. 2007 happens, and sometimes things do go sideways. And if things have to go sideways, I'd like it to be the case that the worst thing that can happen is I lose the house, not I lose the house and all my wealth. So we always structure these seller finance deals to be what's called non-recourse, which means that the worst thing they can do is take the house back. They can't take the house back and go after my personal assets. So I do not sign personal guarantees when I do seller finance. You are signing a personal guarantee, whether you realize it or not, when you do most bank loans. If you're an investor, you're almost, unless you're a billionaire, you're almost always going to have to sign for a personal guarantee to get a real estate loan. And then, just as an aside, some investment loans with banks have prepayment penalties. If I decide that I want to pay it off sooner, I've got to go to the bank and beg their permission to do it. And in some cases, they will charge me because they planned on getting a year or 2 years or 5 years of interest. And if I pay it off sooner, they don't get that interest, or at least they're not going to get that interest. So they may charge me the lost interest that they're not going to get. I don't have that. We don't structure those kinds of deals with sellers. Sellers don't typically care about that. For a seller, getting their money back sooner than expected is a good thing. It's a reason to celebrate, not to penalize. So we don't have prepayment penalties when we work with seller finance sellers. So I do want to discuss now the three elephants in the room, because whenever I start talking about seller financing, particularly with U.S. folks, but I suspect now it may also be the case with non-U.S. folks, there's the big three questions that are floating around that people are too polite to bring up, so I'm going to bring them up myself. First one is, I don't know anybody who does this. This can't be real because nobody that I know transacts like this. And well, now you can all say that you know at least one person that does, because I do and have been doing it for decades. But just to be clear, I didn't invent this. This has been going on for quite some time. Selling with seller financing is not new. Selling with terms is another way of calling it. It's not new. It's not novel. It's just that the banks have done a really, really good job of convincing everybody that the right way to buy a house is to go to a bank, at least in the U.S. Now, in other countries, that's not the case. In other countries, if you want to buy a house, you have to accumulate that kind of cash and you buy the house. They don't have the kind of loan programs in many countries that we have in the U.S. But in the U.S., I often get this dazed deer in headlights look, because when I'm talking about this, they look at me and go, I didn't even realize this was possible. I don't know anybody who's ever bought a house that didn't involve a bank. Well, now you do, because we've done, I would say hundreds, but at least dozens and dozens and dozens of deals like this. And we know people who've done dozens more. So unfamiliarity is the big one, but that's easy to overcome because you know me. Okay, fine. The next one is legality. I've had people say, well, I'm not sure that that's legal. I'm not sure that you can actually do that. And the answer is, again, the banks have convinced you that the only way that you can legitimately buy a house is with them, which is brilliant marketing on their part. But there's absolutely nothing illegal about what I'm proposing. You would and will close this exactly the way you would any other loan. In, let's say, Georgia, where I've done the bulk of my investing. Georgia is a closing attorney state, so you close with closing attorneys. We close seller finance transactions with the closing attorney just like you would any other transaction. There is title insurance. There's a title check. All the things that you would have with a regular, quote unquote, regular closing, you have here. There's a settlement statement. There's no difference except that there's no bank involved. And so it's a whole lot faster and a lot cheaper. But there's nothing setting these kinds of closings apart from the kind of closings that you would see if a bank were involved. So this is absolutely legal. There's nothing spectacular or special about these kinds of transactions. We've closed with title companies in Oklahoma. We've closed with closing attorneys in Georgia. The legality is, the law is indifferent to whether or not the seller gets all their equity at closing or takes terms over time. And then the third one I get is, okay, but no one's really going to ever do this, right? Why would any seller willingly accept anything less than all of their equity at closing? Why would that happen? This must be a fairly rare thing, right? They say, to which I say, no, it's actually pretty common. And it's going to become more common now mostly because of demographics. You've got a bunch of older folks, we call them baby boomers, who are born from 1946 to 1964. So they're 70s, 60s, and 50s who are holders of a lot of real estate, and they're getting ready to retire, to go sit on a beach someplace, and they want to sell their real estate holdings. In some cases, a lot of these folks are landlords. They have a bunch of property, and they know that if they have 10 properties at $100,000 each and they sell their entire portfolio and they get that $1 million check, Uncle Sam, which is what we call the IRS here in the US, for those of you who don't know, is going to have a field day and tear that $1 million up. So what we can come to those folks and say is, hey, would it benefit you, Mr. Seller, if instead of getting $1 million at closing and getting eaten alive in capital gains taxes, what if you instead receive your payment over time, maybe the next 20 years? Maybe we gave you a reasonable down payment up front at closing, and then payments, monthly payments for the next 20 years. Would that be of benefit to you? Simply a question. We're not asking them to do owner financing. I don't typically, the word seller financing don't come out of my mouth. I never approach the seller and say, hey, will you do seller financing? I simply ask, would it benefit you if you took your gains over time and spread this out from a tax standpoint? Would that benefit you? And some sellers go, no one's ever asked me that before. In fact, most of them say that. No one's ever asked me that before. Let me think about that. Or let me talk to my accountant about that, which I love, because inevitably when they come back with their having talked to their accountant, they go, tell me more about this whole terms sale. And then I know I've got them hooked, and the odds are pretty good that we're going to make a deal happen. So I won't tell you that every seller that you talk to is going to want to do seller financing. I won't tell you that it's a 100% strategy, because it's definitely not. If you're dealing with somebody who is going to use the proceeds of this sale to go buy more real estate, then yeah, they're going to probably need their cash, unless you can sell them their real estate, unless you can trade them their real estate. But if they need that cash to do something specific, and they need most of that cash or all that cash to do it, then clearly a seller finance solution is probably not going to be the best one for them. But these days, that situation is, while it's there, it's rarer. And what's more common is they may need some of it. So in the case of the 10 properties at $100,000 each, you might need 50,000, maybe even 100,000 of that $1 million gain in cash. But the other $900,000, do they really need that right now? Probably not. And if they don't need it right now, then that gives you room to suggest a structure that pays that over time. And if you can create that structure that pays that over time, then you basically just created out of thin air room for yourself to do a deal that doesn't involve all cash. And you've seen what that does to the cash and cash return. So you basically created equity for yourself, or at least you've created opportunity, more money for yourself out of thin air, just by asking these questions.